Welcome everyone to Vested Interest. This is Shane back again for this week's portfolio update. And before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos. And a special thank you to those who subscribe to the channel. I really do appreciate it. On this channel, we cover dividend growth investing. And for those of you who may be stopping by for the first time, well, it's not rocket science. In my opinion, the best way to do anything, keep it as simple as possible. It really just boils down to consistently investing, dollar cost averaging, whether that's weekly, monthly, quarterly, or once a year, into dividend growth stocks and growing companies with positive cash flow that covers the dividends with a high return on their invested capital. I cover all my investments into the portfolio every week. That's what this portfolio update is about. We'll look at the $1,424 and some change that I added to the portfolio. We'll cover the dividends paid out for the week, if any were paid out. We'll cover any options that I were involved in this week. It's free to see what I'm doing on this channel. We all have enough to pay for. But if you would like to help out the channel, go ahead and hit that thumbs up. Hit that subscribe button down below. Join us on this journey to financial freedom. Join the Vested Interest community. And hit that notification bell so you are notified whenever we post any new content. Drop a comment down below. Let me know what you added to your portfolio, any dividends you were paid out, and any options you may be involved in as well. So let's jump into the video and see what activity we had in this portfolio this week. We are going to start out on, well, it says February 16th, but the options were placed on Monday the 12th. I actually wrote these over the weekend. We had a lot hit this week. It's not a typical week, above average, but it was nice to see. We had 4 different option contracts sold to open this week. We had one option on Cisco, ticker CSCO. This is out of the information technology sector. All of these were set to end on February 16th, which was Friday. You can see down here. So here's where we opened the options. Here's when they closed on the 16th. So opened on the 12th, Monday, closed on the 16th. So we're just doing weekly options. All total, it amounts to $125.80. So back to Cisco, right? Closing date February 16th, strike price of $53. This one we'll jump down here below. Right here, you can see it expired worthless. So we keep this $38.45 and we keep the 100 shares. Now we did one contract on Kraft Heinz, ticker KHC, out of the consumer staple sector. Same thing, February 16th, close the contract on that date. $37 call, we received $39.45. Let's look down below. This expired worthless, so we kept those 100 shares of Kraft Heinz, kept that $39.45 in options premium. Nutrien, ticker NTR, this is out of the material sector. This is a Canadian company, so there are some tax implications if you hold this. We had a $51 strike price. We got $24.45 in options premium. We'll jump down here. Nutrien was assigned, so that means these 100 shares in this contract, one contract equals 100 shares, were called away at a $51 strike price. I think it was like $51 and some change there, 12 cents, I believe it ended up. So we didn't end up on the positive side of that. You know, $24. If you count the $12 we lost because we sold it at $51, not the $51.12. We ended up keeping, $11 and some change over what we would have been able to sell them outright for. But what we will do now is we will run another options play coming this week on Nutrien, those same 100 shares at the same strike price, $51, and then we will keep the options premium there and try to pick up those shares back at $51 or even lower if it drops back down. And last but not least, we did one contract of Bank of America, ticker BAC, out of the financial sector, $33.50 strike price, $23.45 in options premium. This one also was assigned, so 100 shares called away, and we'll do the same thing. We'll run that wheel again. We'll probably actually run another contract on each one of these same positions. I had Pfizer on this list. That one didn't hit. I had a couple others that did not hit. These were the 4. I think we put out 6 or 7 contracts. These 4 are the ones that hit. Again, all total $125.80 in option premium. This goes right back into the portfolio. So the reason we are running these options, it is a way to create some more income to go into the portfolio over time. So these 2 that were assigned, again, the Bank of America 100 shares and the Nutrien 100 shares, we will do the opposite next week and run the wheel. So this was a covered call. That means we owned 100 shares. Next week, we'll take the cash that we received from these and do what they say is called a cash secured put. So we'll take those 100, the funds anyway from those and run another contract on 100 shares of Bank of America and 100 shares of Nutrien. We'll do the covered calls again on Sysco and Kraft Heinz. Now, just because we set up a contract doesn't necessarily mean that someone has to take it. They look at it, they see if they like it. If they're willing to sell 100 shares at the strike price that we set with the expiration date that we set, and then we enter into a contract. Again, we keep that premium whether the shares are called away or whether the shares are kept in our portfolio. We keep that premium. The only difference is with the ones that were assigned, we now have the cash from those sales, and then we will run, instead of a covered call, cash secured puts on those two positions. So Sysco, Kraft Heinz would be covered calls. Bank of America, Nutrien will turn into cash secured puts, and that's what the wheel strategy is. So you start out with either a cash secured put or covered calls. You either own 100 shares or you have the funds to have 100 shares, and you open an options play on that, and then whatever happens after that, you continue to run the same options over and over and over again at the same strike price. So we will look to do that next week. Hopefully that makes sense. Drop a comment down below if you have any questions about options. Now let's jump over to February 14th. First dividends paid out for the week. Enterprise Product Partners, ticker EPD. This is out of the energy sector, paid as $112.21. Now, we do have the DRIP set on. That stands for Dividend Reinvestment Plan. That just means that anytime a company within the portfolio pays out dividends, the $112.21 in this case, they go right back in and buy more shares of that company. So we picked up 4.21066 more shares of Enterprise Product Partners, continuing to build out that position with the options. I didn't add any new capital. The positions I have already bought are adding the new dividends and adding new shares of that company. So these 4.21066 shares added an additional $8.67. So now you can see that dividend snowball in effect. I bought shares of Enterprise Product Partners. Those shares paid out dividends. Those dividends go back and buy more shares. Those shares add more income. That's the dividend snowball over time. Continues to get bigger and bigger. It is a slow growth, right? So if I was to want to make this speed up a little bit, I would add more capital to Enterprise Product Partners. Right now, I haven't really been. I think I picked up some shares maybe a couple weeks back, but this one I have not really been adding to, but I'm letting the dividends do their thing. So $8.67 in passive income added by that 4.21066 more shares. And this was really the most active day for dividends, and that should say February 15th, not the 14th. So on February 15th, we received $338.97 in dividends, and those dividends were broken up between these four companies. Omega Healthcare Investors, ticker OHI. This is a REIT. They paid us $185.73. These funds went right back in, bought 5.97835 more shares. Ally Financial, out of the financial sector, ticker ALLY, paid us $70.07. That $70.07 went right back in, picked up 1.90987 more shares of Ally. Procter & Gamble paid us out $31.71. That $31.71 went right back in and picked up 0.20204 shares of Procter & Gamble. This is out of the consumer discretion or consumer staples sector. And Realty Income, the monthly paying REIT, paid us $51.46. That $51.46 went right back in and picked up 0.98321 more shares of Realty Income. All total, these new shares added an additional $21.59 in passive income in dividends. Really, they'll pay out. That'll be the dividends paid out from these positions. That'll just add to the existing positions, right? $21.59 on top of what they just paid out over the next calendar year. And we finally get into the first new capital invested. We invested $932.12 on February 12th. With those funds, we picked up 4 shares of Cisco Systems, ticker CSCO. This is out of the information technology sector. So not only did we run an options play on Cisco, we added to the position overall. We picked up those 4 shares at $50.09. I believe this actually dropped a little lower, down into the $48 range. So this one might be one we continue to add to over the next couple of weeks if it continues to stay under my cost basis. We added 10 more shares. We've been adding 10 shares a week to Alibaba Group. Now, this is a Chinese company. I know some of you out there are going to be completely against buying Chinese companies, and that's okay. I'm buying it right now. I think it's too cheap. As a matter of fact, I started a position in my daughter's custodial accounts into an ETF, Franklin Templeton ETF, in specifically the Chinese economy. I believe they are very cheap right now, and I'm not afraid to add to them It's just part of the overall world market. Some people might just want to stick to American stocks. That's fine. But for me, I did add 10 more shares to my BABA, ticker BABA. This is out of the consumer discretionary sector. We picked up those 10 shares at $73.18. And these 10 shares of BABA and 4 shares of Cisco added an additional $16.40 over the next calendar year in dividends. And lastly, on February 16th, we added $492.65 more. And with those funds, we picked up our weekly buys, right? We're buying 1 share of VTI, which is the Vanguard Total Stock Market. And that's just exactly what it says, the entire United States stock market. And we picked up that 1 share. This is the ETF, that 1 share at $249.80. And it doesn't matter where it's at. We're going to buy 1 share, at least 1 share. If this was to drop significantly below my cost basis, I might jump it up to 2 shares a week. But for right now, we're just going to add 1 share of VTI and 1 share of SCHD. These are going to be our weekly buys all throughout the year. We picked up that 1 share of SCHD. This is a dividend growth ETF right here, Schwab dividend growth ETF at $77.21. Same thing. I don't care what the price is. I'm going to add at least 1 share. If this was to drop back significantly under my cost basis, I might jump it up to 2 shares, 3 shares, 4 shares. But for the rest of the year, at least 1 share per week. And this is our newest position, Comcast Corp, ticker CMCSA. This is out of the information technology sector. We picked up those 4 shares at $41.41. So similar to BABA, we will probably add 4 to 5 shares here every week going forward until we build this one out significantly, or it jumps up significantly in price. This one actually has dropped back a little bit. I'm hoping it drops back more down into the 30s. I would like to build this out and decrease my cost basis on it. All total, these new shares added this week added $13.36 in dividends over the next calendar year. Total invested for the week, $1,424.77. Total passive income with all of the dividends paid out and the new positions we added, $60.02 in passive income added over the next calendar year. Now on to the sector weights. Here we're going to run through this real quick. Communications is making up 9.2% of the portfolio. Consumer discretionary sitting at 4.24%. Consumer staples sitting at 11.72% of the portfolio. Energy makes up 6.25%. Financials at 8.25% of the pie here. Healthcare is the largest piece at 16.77%. Industrials makes up 7.55%. Technology at 7.40%. Materials makes up 11.97%. Utilities sitting at 4.48%. NextEra Energy, that's all is in my utilities. They actually raised their dividend here. We'll go over dividend raises here in a minute as well. We've had a couple in the portfolio that raised their dividends this week. REITs and real estate, 11.07% of the portfolio. And ETFs with the VTI and the SCHD positions finally just breached over 1% of the portfolio, sitting at 1.09%. Over here on the right, you can see same sector weights, breakdown by percentage, and also the amount allocated in funds over here on the right. So you can see how much I actually have invested into each sector here. Now, what a lot of you come to see every week, and again, I'm going to show you this whether the market's up, whether the market's down, whether the market's floating sideways, and whether I am up, whether I am down, or whether I am floating sideways. I'm going to show you what a real portfolio looks like built out over time, my additions to the portfolios, any sells, any buys, any dividends paid out. You will get to see it here. I want to be out in the open and fully transparent. For those of you who may think that investing is too hard for you to do because you don't have a background in it or anything, that's the whole idea of this channel. I don't have a background in finance. I'm not a financial guru. My parents are not investors. We don't own any kind of investment firm or anything like that. I am learning along the way with you, so hopefully you can learn from my mistakes. You can benefit from the things that I do right by watching this. And for those of you who maybe have not started your own journey, hopefully this helps show you that you too, just an average person, can start your own portfolio and build one out over time. And we're going to have misses. Obviously, you can see all the red in the portfolio, right? I'm down, for example, MPW, I'm down 55%. But then other positions, WSM, wish I'd bought more. This one, I'm up 88.48%. OC, Owens Corning, I'm up 52%. Ally Bank, I'm up 40.66%. So you're going to have some losers. You're going to have some gains. Overall, don't let that discourage you. When I see red, I actually see buying opportunities. If I liked Kraft Heinz at $36.60 and nothing's changed about the company, I should like it even more on sale at $34.82, right? That's my approach to this investing game here. So here you can see all the tickers. These are all the positions in the portfolio. Total shares I own as of the close of business on Friday. Current price as of the close of business on Friday. The market value. Average share cost. This is my cost per share. This is my cost basis. Whether I'm up or down in this column right here. Percent I'm up or down in this column. What sector each company falls in. Whether it's a quarterly, monthly, semi-annual payer. The current dividend yield as of the close of business on Friday. My yield on cost. The portfolio weighting. So the previous slide, we saw each sector's weight. This is for each individual position. I don't want any one sector to be over 20% of the portfolio, and I don't want any one position to be over 10% of the portfolio. Estimated annual income sitting in this column, what months the company pays out, the dividend growth year over year, and where it sits at 15% of its 52-week low. So this gives me kind of a cap of where I want my average cost per share, and this adjusts over time. Right? As a company goes, their 52-week low goes up or down, then this will adjust over time. Let's use Alibaba as an example. My cost basis is $73.10. Currently, it is over my cost basis. I don't typically like to buy a company when it's over my cost basis, but at $73.90, it is still under the $76.62, which is 15% of its 52-week low. And this actually I just adjusted. If you remember last week's video, it was at $80. Well, BABA over the last year has hit a new low, right? So that changes where it sits at 15% of its 52-week low. So I will continue to add to this position so long as my average share price, $73.10, is under $76.62, even if the price I'm paying is over my cost per share, right? Does that make sense? Hopefully that makes sense. If it doesn't, drop a comment down below. I'll try to walk you through it. Now, highlighted in yellow, I'm going to highlight these throughout the year so we can watch what companies have given us a dividend increase over the year. You can also see the dividend growth over here. Some of these companies are not growing their dividends right now. I'm hoping that they pick that back up. Ally, for example, hasn't grown it in a couple years. SBSW, no growth there. That's MPW, no growth. They've actually recently cut their dividend. Same thing with Kraft Heinz, no growth here. I'm hoping eventually they pick this back up. And at some point, I'm going to have to make a decision whether or not I want to keep these positions in my portfolio. I might give them a couple years, 2-3 years to start their growth again, and then decide to switch these positions into something else that is growing. I want dividend growth over time. Right now, my growth is at 5.07% year over year, averaged among all these positions. So currently, total shares sitting at 6,000. Oh, well, let's go back. So Cisco, ticker CSCO, just raised its dividend. Enbridge has recently raised its dividend. EPD, Enterprise Product Partners, recently, and NextEra Energy. The most recent dividend raises were Cisco and NextEra Energy. Those were both this week. Very nice dividend growth in both of these. NextEra Energy being the highest at 10%. Cisco at 2.61%. Enterprise Product Partners, not much growth there, 0.02%. I mean, that's just barely any growth. You could just call it no growth, really. And Enterprise Product Partners, very high dividend yield, 7.56% currently. My yield on cost, 8.364. And paired with nice dividend growth, 5.25%. If I could get all my positions right with a 7+% dividend yield, plenty of room to cover the dividend with nice dividend growth, 5.25, I'd love it. But obviously, that's not realistic. So let's go over here. Total shares, 6,011.594. Market value sitting at $209,910.75 as of the close of business on Friday. I currently have $207,111.33. My total return, I am up slightly, $2,799.42 or 1.35%, but I don't really focus on this. I don't care if I'm up or down. That's not my focus right now. Current yield sitting at 4.569%. My yield on cost, 4.631%. And that's why I have it circled in red, is what I'm focused on. The dividend growth paid out over the next year, $9,591.74. And this continues to grow, whether the market's up, whether the market's down, whether the market is floating sideways, as I add new capital, as the companies in the portfolio increase their dividends, as the companies in the portfolio pay out new dividends and buy more shares of those companies. That is what that dividend snowball is. So there's several growth factors in that dividend snowball. Me adding new capital, the company increasing its dividend, and the company paying out dividends. Most of these are quarterly, except for ticker O, that's a monthly payer, paying out quarterly 4 times a year will increase that snowball, whether I add anything to it or not. And we do have a couple of semi-annual payers here, SBSW, Siboney-Stillwater Mining Company. They only pay 2 or 3 times a year. Valet, same thing, 2 or 3 times a year. BABA is only going to pay out once. Right now, they're only paying out in January. So I know I've got them in the semi-annual payer, but they are really just annual. I just didn't want to add another tab. When I added another tab, it kind of made it hard to read some of these. This is starting to get a little small for those of you us getting older. Make sure you got your glasses on and you can see this. And overall dividend growth year over year, 5.07% on average. So that is the portfolio update. Drop any comments down below, any questions you have. And as always, appreciate you stopping by. And if you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, hit the subscribe button and join us on this journey to financial freedom. Join the vested interest community, building a community of like-minded dividend growth investors so we can share our experiences. We can't benefit from each other's investing, but we certainly can benefit from each other's experiences. Again, that's why I do this. You can see all of my mistakes out in the open. You can see all of my good moves out in the open, and hopefully it helps you along the way. Don't blindly copy what I'm doing. I'm in my mid-40s. Some of you might be younger. Some of you might be older. We all have different time frames for retirement and investing criteria. Make sure you are investing based on your investing criteria. Well, that's really it for this one. Appreciate you stopping by. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. I do a stock pick of the day series Monday through Thursday. So if you are interested in a company and want me to do a stock pick of the day series on it or video on it, drop it down below and I'll work into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investor journey for educational and entertainment purposes. Investing involves risk, and money should never invest any amount. Not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice of a certified financial advisor.